Sunil Subramaniam joins us now. Let's take a conversation forward. Sunil, good morning. Thank you for joining us. 5% reversal in small and mid-cap stocks, and the big question is being asked, are we in for a repeat of 2017 and 18?
No. So what's the reason I say that? Is that 2017-18 saw a decline of the Indian economy in progress. I think the trigger there was the negative inflation in rural India, followed by the financial crisis, right, in the ILFS and DHFL and all that. So the mid-cap decline was strongly correlated to a downtrend in the Indian economy, which was there even till the COVID hit us. And then COVID gave it a further dhakka, right? Today, the situation is the opposite. We are on the back of a rebound in the economy. Post first wave, we saw some rebound, then the second wave damped it. Now, the vaccination story is improving, the testing is improving. I think even a third wave comes in, the confidence of the economy can tackle it, right? I think is growing. So the Indian economy, and you see good news on the exports front, good news on the PLI investment front, lots of announcements of capex. So I think that this is just a bit of profit taking because, as you know, retail participation is what has driven this rally. And naturally, there is a certain amount of profit booking, which they will see their money doubling, tripling. They're taking money off the table. But the underlying story is of an Indian economy in a recovery mode. And by next year, we should be full on. I mean, this year was 1.5 are, remember, because of the low base of last year. But a sustainable 7 odd real GDP growth percent augurs very well for the mid and small cap space. So I would say long-term investors should look at the correction to actually buy into the quality mid caps. And that's the differentiation I want to make, Nikunj, is that there's been a run-up of everything, right? There's a lot of froth. Quality was given the bygone in terms of the rally happened post the first wave ending. So I think now the quality, that is those stocks which can benefit from the economic revival and not just on news flow, I think are the ones which will benefit. So it's a good time to do selective buying across the mid and small cap thing. I don't think this correction in the indices is something sustainable because Indian economy is on the mend.
How much of the template which you just mentioned, Sunil, while the template is 100% right, since markets are forward-looking, is already in the price. So what you are saying may well play out. Economy will grow, earnings will come, but maybe it's in the price.
Yes, what happens between what's in the price, Nikunj, is the difference between a safety play and a cyclical growth play. In a safety play, you can say that it's in the price, so you can only expect normal growth rates as the earnings comes and meets expectations. In the cyclicals, despite past evidence of V-shaped recovery in earnings, market always underpredicts the recovery in cyclical. So whatever the markets are saying, right, I would say that the earnings will still come and give you an upside. The only difference is the timing. If market expects it by 22, 23, it may not happen. It may happen by 23, 24. But if you hang in there on the industrial cyclicals belt, at a time and point, that's the theory of linear thinking, right? When you have something going 12, 10, 8, markets predict 6. When you have something going 8, 10, 12, market predict 14. But the fact is that it doesn't go in a linear line. When fixed costs, and what is the key in the small and mid cap segment, Nikunj? Economy sensitive stocks in that segment have high fixed costs and high interest costs, right? So the increase in the top line, a 10% increase in the top line will lead to 20, 25% increase in the bottom line. But market will not take such a strong leap. So they will come weighted average and put it in between. So when you pick a good quality company, when I say quality, I'm not talking about predictability of earnings here, which is the case in say IT and other safety sectors. The quality of the stock is the ability of the stock to invest in capex at the right time, build its order book and deliver. So it's a very, very technical thing in terms of the quality is the capability of that company and the organization to meet that demand surge. So picking that quality, I'm telling you, is that when the surprise element, that earnings exceeding market expectations or the consensus is what is really going to drive this sector up.
Hi, Mr. Subramaniam. Good morning. This is Mubina as well joining in. You've given a lot of key drivers behind this rally that we have seen in mid and small caps, retail participation being one of them, and many other factors. Mr. Subramaniam, going forward, what shape do you see this market take? Will it continue to be one of those markets where, regardless of PE, regardless of valuations, you see a run up in the stock? Because to some extent, that's what we saw in the last 1 year, which was again, in turn, one of the reasons why we saw such retail investor participation.
Yes. So, Mubina, the key point here is that when you look at the forward direction of the market, right, what you got to remember is that there are two very different segments in the market. One is the established old world companies, right? Some of which are well valued because there is predictability. Some of which, as I mentioned, are cyclical and a V-shape. But that's all I'm talking about is in the manufacturing space, where by and large things are predictable, right? And the PLI scheme, the infrastructure pipeline, the real estate housing thing is going to drive them forward, right? But there's a huge another segment, and that's what I call the emerging India, which are largely in the services sector. So if you take the services sector, right, in terms of the fact, it's the most informal of all the sectors. So what I mean by that is that if you take, it's about 55% of India's GDP comes from the services space. And why is that not reflecting the stock market? Even today, the stock market is only reflecting 36 to 37% as a services market cap. So there's this huge 18% gap with the real economy that's driven on services, which is not reflecting in the capital markets. What the recent boom has done is get all these companies to come into the stock market through IPOs. So all the IPOs, which are largely, if you can bucket them, will be in the services space, right? That's where the fact that they are coming in for the first time means that A, there is no valuation history, there's no methodology to how to value them, there's no earning predictability, because these are all businesses which start small and scale at 100 times, right? So how do you actually put a model? So the market will be in a discovery phase. And that's where retail investors are entering, because they have a close connect to these companies in their day-to-day life. Now, they don't know about the stock market. They are new investors. The whole explosion of demat accounts and retail in India is coming from investors who sense that the internet, the digital world, the easy ordering, that's their world, and they sense it. And they say that company is coming to the stock market, I'm confident it will do well. He doesn't care about valuations. Now that entry, right, those two are matching each other. And as the way forward goes, I see that this gap with services industrial share, economy share and services market cap share has to narrow. So the scope is how many such companies are going to take up that interest. If you have a very wide set of IPOs coming in, then the froth can get spread across the lot. But definitely your new age investor is going to invest in companies which he can understand and not in your traditional cyclical kind of a bet. So I think that's where you're going to differentiate the direction of the market, is that the new IPOs are going to come and absorb a lot of this liquidity in newer areas, and there, as I said, the valuation models are going to keep surprising you, and the prices can keep rising. So to play this market, then you got to have that balanced perspective, because as a market participant, it is not just about your analysis and what you pick. It's also an understanding of what the others are buying and what is likely to then go up. So there has to be a balanced approach, that you can't have a rigid approach saying, oh, this is the way I always did my business, this is what will work. No, the world is changing. How that world is going to affect, including the stock market, is changing, and an awareness and a balanced approach is what will pay off.
So Sunil, basically, businesses that are simple to understand for the mass, I think that's the direction that you're taking. What would be those businesses then? You said that liquidity will be absorbed by a lot of new IPOs. Most of them are coming from these, most of them, not all of them, of course, but many of them are coming from these new age internet businesses. Do you understand that going forward, the market leadership will be taken by simple businesses, businesses that you and I and the general mass understand? Like, for example, a Zomato, we know what that business is. We know what the business of Swiggy is, Paytms. Do you think that's where we will see the next round of market rally?
Yes, I think you've hit the nail on the head, Movina. I think for a new first-time investor stock market, how does he come in? It is his understanding that that business will succeed, right? So all of these things, you mentioned Zomatos and Swiggies and the Ubers and the Olas and the Oyos. See, these are all where they know that this is what I'm going to be doing, right, in my life, and these fit. So I see a success. See, and you go back to 3 decades ago. What was the favorite stock which everybody said that is a good long-term buy? Colgate Palmolive. Why? Everybody said, I use toothpaste. I know this forever till I die. I'm going to use toothpaste. So that's the time when that businesses, were felt to be long-lasting. Today, this generation, right, is going to see that what is simple, what is adding value to my life, is that coming to the stock market, then that's what I'm going to invest in. So I think that awareness, what you said, is I agree with that fully.
Okay, all right. So, what happens then to your classic traditional businesses? You have, of course, the more relatively secure, relatively less volatile businesses, like, for example, large banks. Your FMCG companies, your metal companies. What happens to those then? Do you think that after this rally that we have seen in many of them, especially metals, in this last 1 year, that it'll start tapering off? It'll start slowing down now?
Not necessarily. See, the stock market today is a three-way pie. There's an FPI pie, there's a domestic institutional pie, which is your LIC, insurance, mutual funds, and then there is this retail pie. So what I spoke about was in this and simple businesses understanding is the retail pie that's going to go. FPIs are always going to look at two things, right? One is how's the world growth, where is India going to benefit? So export plays like IT and pharma and global cyclicals like metals. So FPIs will be looking at global trends and then pick the Indian companies to buy those. And the domestic mutual funds, by nature of their existence, are going to be diversified. So they're going to have share of everything. So they cannot get focused into one. I mean, there are focused mutual funds which can do something like that, but by and large, it's diversified. So when 2/3 of the play, right, your FPIs and domestic institutions are still going to be buying the broad-based old economy market based on the fact that the whole infrastructure story, right? I mentioned the three pillars to infrastructure are national infrastructure pipeline, the PLI scheme, and the housing real estate sector boom. These are structural changes which are going to benefit in terms of actual earnings, and the institutions understand this model well. So that's where they will put their money. So they will continue to get support. So the rally will not fizzle. In fact, these people will drive those up. Retail investors, right, where if and when there's a correction, you got to see how they behave. It's an unpredictable, this new set of retail, right? When suppose there's a strong taper announcement and there's a strong reaction in the larger cap space in the market, right? How will these retail so-called Robin Hood investors react is still an unknown commodity, right? So far, they have shown a resilience. I hope that sustains and continues. But if they panic, if that happens, then the froth in these new age IPOs will come down. Then your old economy, traditional valuation-based, model-based thing will dominate the stock market. So I think what you say is that one section of the market may drive this one way, but overall the market, the mix may change a little bit, but I would still say our standard fundamental growth at a reasonable price basis of investing in the market is not going to go away and will continue to support the kind of sectors that you spoke about.
All right. Okay. Well, we've spoken a lot about new businesses, about the more traditional ones. Right now, if we have to construct the retail investor's portfolio, what would be the mix you would recommend he or she puts into their portfolio?
So I would say that. So if I may define 3 buckets, which is carrying forward our just now the discussion, right? So I would say there's a safety oriented. When I say safety, it is the degree of certainty of predictability of the earnings stream. So I would put IT, consumption, all of those into that bucket, right? That's one bucket of investment. The second bucket is the Indian economy's revival story, which is largely a cyclical, industrial, rate sensitive. So in consumption, it will be consumer discretionary, auto, housing, and your capital goods suppliers. So that's the second bucket. The third bucket is this new age companies coming in, which they have no history in the stock market and are coming in through the IPO mode and are presenting exciting opportunities. So I would suggest to the new age investor that a 30-40-30 allocation. 30% on the predictable earnings stream, 40% on the cyclical going to be V-shaped takeoff scheme, and another 30% in these simple to understand but new to the capital markets kind of businesses, which you can participate through IPOs or post-IPO through the market. So that's the mix for a new age millennial kind of investor that I would recommend at this stage.
Okay, all right. So that's of course about a simple portfolio that Mr. Subramaniam would construct for new age retail investors. And Mr. Subramaniam, just before I sort of wrap it up, I wanted to ask you that we are done with the first quarter of FY22. We have earnings that have been, well, some good, some not so good, leaving investors wanting more. So earnings are done. We have the possibility of a third wave looming large, and usually if the markets have to go higher, they wait for a trigger. What could be that next trigger?
So the next trigger is the continuance of the monsoon and the festival season related demand pickup. Because of the second wave, consumption has been held down, and so that pent up demand combined with the fact that festival season will see festival bonuses in the eastern side in the Durga Puja, in the western side and the northern through Diwali. So that will put a lot of money in people's hands. And at that time, the third wave, in terms of can we hold it off? How does the vaccination progress? So data around vaccination progress from a domestic perspective, data around the monsoons progress, data around the third wave's actual arrival. If it beats the festival season, if you're able to push the third wave beyond the festival season, you'll see a massive rise. And I think that will then be a trigger. So in terms of time frame, I would say somewhere between Puja and Diwali is the time the trigger market will look at these numbers. But it's not important just to look domestic. On the overseas front, right, how does the US numbers look? See, the Fed is trying to calm the markets and keep speaking that, oh, tapering is very far away. But the Fed has to be a slave to real data. And if the real data surprises on the upside, the Fed will just forget its past peak and say, oh, now the data looks good. This inflation is no longer transient. We see that it's sustainable, and they could announce. That's the one trigger which you all to keep in mind in terms of over. There was a trigger around oil a few months back, but I think that is easing, I would say, in the sense of the Iran thing solution, the OPEC and the US shale guys, the break-even costs having come down substantially, they can always increase supply to keep. So oil is not as much of a worry as it was a few weeks ago. So for me, it's a US growth inflation framework matrix that you still have to keep an eye on the FPI's actions around here. So to me, Diwali is a trigger where the markets could touch new lifetime highs, unless, of course, the risk factors that I mentioned happen.
Great to have you on the show as always. Thanks for taking the time out. Let's take stock